So I think we should maybe step a little bit back here and cover a bit of the basics here, because I think a lot of people are, one, new to CØSMOS, and two, also new to synthetic asset marketplaces, right? I mean, we've been talking about this now for months, and it feels like years, but for some people that are new to crypto, this is they're completely puzzled right now. So I'll try to explain a little bit of the basics, and then you can take over and jump in and correct me also if I say anything that's wrong. But in short, I think the real innovation of synthetic assets in the crypto space is that you can basically bridge anything that's being traded in traditional finance, right? Maybe gold or stocks or other commodities, and you can bring them into the crypto ecosystem, and in COMDEX case, into the CØSMOS ecosystem, which means you have interoperable, fast finality, low fees, right? All these great features that we love about CØSMOS, and you can trade these assets there. And on top of that, you also can deploy different yield strategies, right? Because crypto is just there to enable that, and it's 24/7, it's around the clock. So this is very interesting for institutions to offer to their clients a faster, better, more accessible, around the clock way to invest and to increase their investments, right? And I think there's also two main categories that you can differentiate. One of them being this classic collateralized depositions, which is what you guys are doing at COMDEX. And then the other category would be this mint and burn model, right? Which is something that also I think Terra has pioneered a lot. And now we're seeing the ionized proposal. I talked about this extensively with Sunny. And now we have also a Silk coming up in the secret ecosystem. So can you share your thoughts, and maybe also, I don't know if that was helpful, this explanation, from your views, why synthetic assets are such a revolution in the crypto space, and also then go a little bit deeper into how COMDEX is structured, go deeper on the CDP model, and what makes you guys so unique in that field.
For sure. I mean, from the synthetics perspective, I think I saw the video as well with Sunny a couple of days ago for the ionized proposals. He did a great job of explaining what they are. Talking a bit about how synthetics are going to revolutionize finance, or why it helps revolutionize finance. I think the way to think about it is looking at both sides of the coin. So let's for a minute look at how it benefits investors to have synthetics. So, firstly, it's giving me access to a whole range of asset classes that I traditionally don't have access to, because I choose to be, let's say if I choose to be an investor who wants to remain, decentralized, and I hold Atom and other assets within the CØSMOS ecosystem, but I'm looking to take exposure in commodities like gold, silver, crude oil, or looking to take exposure in equities like Twitter or, Netflix or Amazon or Microsoft. I would have to go a very long route to convert crypto into fiat, to create all my licenses, complete KYC, open the bank account, and then be able to trade, I don't know, Twitter, Microsoft, or whatever. So the idea is that in many ways, you destroy all the barriers that exist between you and an asset by just creating a representation of that asset, which holds the same value by being pegged in value. So it's sort of, from an investor's perspective, it's opening up your access. It's allowing you to have 24/7, markets, seamless flow of liquidity between different asset classes. From an investor's perspective, it's also like, speaking in the perspective of commodities alone, for example, if I'm someone who holds a certain amount of gold, or who wants to hedge my exposure to gold by taking opposite exposure, hedging in the real world tends to be very tricky with derivatives, because derivatives come in the form of contracts in the real world, which have expiry. And then upon expiry, there's the whole process of rollover, which can cost money. And commodities, when it comes to something like commodities in the real world, when I say taking exposure to, let's say, wheat, it means me literally owning physically certain amounts of wheat, which is stored in a warehouse somewhere where I own the ownership of that wheat. What that means is that, indirectly, any damage to that wheat affects directly the value of my holding. And it puts me at the risk and costs of that are associated with physical storage, and risks that can come from damage in physical storage. So there's a lot of nuances to different industries and different assets and ownership of different assets. What synthetics does is it kind of strips away the nuances of ownership of any asset and just makes it easy to own an asset by being able to represent an asset in its pure value terms and nothing else. So that's how I think the whole the whole concept of synthetics is able to revolutionize how investing happens and how exposure in different asset classes happen, or how portfolios can be built. I think speaking a bit more about the mechanism, which you pointed out. So, as you rightly said, you can sort of look at it as a spectrum where at the one end you have the CDP model, which is a fully collateral backed synthetic. And at the other end, you have something like what Terra does with the Luna UST mint and burn relationship, which is called seigniorage. So, yeah, I mean, more or less, I think every synthetic broadly can be categorized into two categories, which is algorithmic and collateralized. So, thinking about it in sort of the decentralized realm, Terra has done a fantastic job with UST, and the way it's able to do it is have great adoption for UST across multiple apps within the Terra ecosystem, which in turn creates demand for Luna, which is used to mint, which is burned to mint UST, and vice versa. If you look at something like MakerDAO, the way it works is, you take an asset like an Ethereum, you lock it in a vault as collateral, and then you're able to mint stable coins like DAI against that collateral, so long as your collateral is able to maintain a certain ratio in value against the debt that you borrow against it. So what we at COMDEX, or what we wanted to do sort of, in our approach of synthetics is to have collateral backed synthetics, because generally we think of that as, the safest model to go around having a synthetics protocol. Because when you have a CDP or collateral backed position for a for a synthetic asset, the collateral that you have backing the asset is over collateralized, right? Which means you typically post way more collateral. You post a higher amount of collateral than you borrow in debt, because if there is ever volatility in the market of the collateral asset, that would affect the prices and the value of the collateral that you've posted, and it should always be able to absorb or be insolvent for the debt that you've created against it. So we sort of realized that when you look at MakerDAO today and you look at the DAI, if you look at the total collateral that backs the DAI, a large chunk of it, I think more than 60% of it, is USDC. So although MakerDAO is a decentralized stablecoin, a large chunk of its collateral backing it is a centralized stablecoin like USDC, which we felt is kind of something you can truly address with the power of IBC. Because instead of having all our synthetic assets, backed by one or let's say two assets, like an SNX, it's Ethereum and the SNX token itself, we wanted to have an IBC-enabled synthetics protocol where multiple COSMOS ecosystem assets can be used as collateral to mint synthetic assets. What that means essentially is for all the gold or for all the silver or for all the corn, crude oil, or wheat that exists on the COMDEX protocol, not only is there collateral backing it, but a diverse set of collaterals, which means that if there is ever volatility in the collateral markets, it has a lesser impact on the synthetic asset set. Because at any given point, let's say we have a huge fluctuation in, I don't know, let's say the DVPN market. The DVPN backing for gold might only be 20% of the total collateral. So only 20% of the debt is at risk when DVPN goes volatile, rather than having a large chunk of the collateralization be just one asset alone causing volatility. So that's one way we've approached it, where having an IBC-enabled synthetics protocol spreads the risk of the collateral by having multiple different volatile assets be the collateral for it. And then even the debt that's minted is typically in the form of commodities, which is gold, silver, and these commodities in the long run have very stable pricing, which tends to show an upward sort of momentum, being able to beat inflation in the long run. So for a crypto investor or for a DeFi investor in the COSMOS ecosystem, you could be holding bags of different COSMOS coins. You could collateralize them and mint debt in the form of gold, where you simultaneously maintain exposure on all the COSMOS assets that you hold, and then also on the gold, which won't lose too much value, because gold generally doesn't have a very volatile market.
See that